Rising bond yields are starting to worry stock market investors. Let's have a look. Hello everyone, Florian.heise here and welcome to another episode of Heise Says US. Grab your stein of coffee, let's have a look at this CNBC article which is discussing, well, rising bond yields and the worry about stock market investors. We can see, we jump over here. I mean, the weekly change in the Dow Jones is down 0.3%, the S&P 500 is down 1.9%, and the Nasdaq 100 is down 5.83%, guys. So the market is shaving a little bit today. So let's jump here. Stock investors are trying desperately to interpret what a rise in bond yields means for the stock market. Since the 10th of February, 10-year Treasury yields, which are not inflation adjusted, have moved from 1.13% to as high as 1.6%, a rise of 48 basis points, the highest level in a year. Fear of inflation is causing investors to speculate the Federal Reserve may have to shift policy sooner than expected by either reducing bond purchases or even raising interest rates at some point. That would be a negative for stocks. The Dow was down 559 points on Thursday. Peter Chair from Academy Securities said the recent rise in 10-year bond yields represents a perception about inflation, but not necessarily the reality. The rise in 10-year bond yields does not reflect an actual rise in inflation. It reflects that investors anticipate there will be a rise in inflation, he told me. He notes that the Federal Reserve Chair Jerome Powell has been pushing back against the idea that over-the-top inflation is coming. Yeah, just these are not the inflations you're looking for. You won't have inflation, everyone. Don't worry, you know. Noting in his testimony that broad signs of inflation had not been present in the real world, and if they do occur, such a rise would be transitionary. So who's right on inflation? Bond investors are getting worried about the potential for inflation. Powell says to stop worrying about it. Who's right? It depends on who you ask and what you're looking at. Do we see inflation in the real world? We do in commodities. Oil is approaching the highest since 2018, for example, and copper is at almost a 10-year high. But signs of consumer inflation, for example, have been muted, with inflation at or below 2% for many years. Bulls like Scher insist that in this case, the rise in bond yields is not a negative for stocks. This time, the rise in yields is coming from economic growth, maybe just stimulus and infrastructure. All of this is good for stocks. That's why this rise doesn't scare me too much. He said the rise in commodity prices can be easily absorbed and believes that much of the rise is just a temporary condition reflecting the reopening and that prices will revert back to normal levels over time. Those sound like famous last words, don't they? Hans Mikkelsen, credit strategist at Bank of America, is not so sure. He agrees with Chair on economic growth, but thinks it will be much stronger than anticipated, and that will push inflation up. Since the summer of 2020, economists have consistently underestimated economic growth to an extent never seen before. There appears a real risk the Fed is not going to be able to sound dovish much longer, and that transition could see wider credit spreads, so stocks on edge. The key to the game, Scher insists, is whether Powell can stick to his guns. If the Fed remains committed to keeping short-term yields low, that will give people comfort. We will not get a temper tantrum when rates suddenly skyrocket. Powell has told us he is comfortable with inflation and he is not going to react to short-term movements. I believe he is going to stick to his guns. There is another issue. Because stock prices are so high, there's no room for error. Small shifts in yields could cause tech investors, in particular, to take profits, under the assumption that this is as good as it gets. Veteran stock commentator Michael Farr from Farr, Miller & Washington has already told clients that even this relatively modest rise in rates is a signal. The days of simply piling into the market leaders regardless of valuation may be drawing to a close. Investors must now recognize that there are alternative opportunities out there, including both heretofore underperforming stocks as well as incrementally more attractive bonds. A powerful economic rebound combined with rising interest rates and higher inflation, if that indeed transpires, will change the investment backdrop in a meaningful way. So there we have it, everyone. Bond yields, well, are a worrying sign. for stock investors. What do you think, everyone? Do you think we will see a crash in the stock market? And how are your investments going? I'm noticing some of my tech stocks aren't doing too well. They've shaved a bit, but all the boring dividend stocks I've invested in haven't really moved much. What do you reckon? As always, guys, thank you all for watching. Please like, share, and subscribe to the channel. If you're a fan and enjoy the content I create here, there are a few ways you can help us. You can join the channel on YouTube or Patreon. You can support us using our affiliate links from Amazon, eBay, Independent Reserve, or Aussie Broadband. You can buy a merch from Heise Says, use Gold Pass from the Perth Mint, or support us via PayPal. Take care, and I will see you next time. Bye for now.